Unless you've been under a rock, you'll no doubt have heard about the bail-in of banks via bank depositors in the small island nation of Cyprus. Deposit holders have lost at least 47.5% of their funds when they are withheld from the depositors to fund the banks and avoid their collapse in a taxpayer bailout. But surely a bank failure couldn't occur here in New Zealand. Well, this would have happened to the BNZ in 1990, if not for a government-instigated bailout in the hundreds of millions to avoid collapse. So there is a precedent of a bank failure in New Zealand in the not too distant past. And while the NZ banking system is renowned to be safer than most on the planet, the biggest risk to it probably comes from outside rather than from within. You see, some 30% of our back funding must come from offshore. Granted, this is down from what it was in 2008, but it still means we're reliant upon the kindness of strangers, so to speak, for capital. Our government borrowing may not be as bad as some other nations. New Zealand public or government debt is around 33% of GDP. However, add in private borrowing and we've seen numbers that blow out to over 100% of GDP. The point is, we as a nation owe a lot of money and we need to keep borrowing to keep the balls in the air. Not too dissimilar to most other Western nations. However, a key factor to consider, we believe, is the interconnectedness of the global financial system. 2008 taught us that a decent-sized market shock can reverberate around the globe. The system was only hours from falling over in 2008. So, if there is a credit freeze, then the 30% funding we require from offshore suddenly looks like a big number. And remember that the very nature of the modern fractional reserve banking system means that it doesn't take much for a bank run to occur, as banks are leveraged at least 10 to 1 on deposits. Well, it seems this fact is not completely lost on the Reserve Bank in New Zealand, as after years of planning, a policy to handle a failing bank was put in place in June 2013, the RBNZ's Open Bank Resolution, or OBR for short. What exactly is the OBR? Well, in simple terms, it means a potential haircut for deposit holders of a failing bank. Under the OBR, banks with over 1 billion in retail deposits have been required as of the 30th of June 2013 to set up their computer systems so that RBNZ can, at the flick of a switch, close a bank, freeze a portion of the bank's funds, and then reopen the next day. This way, the statutory manager of the failed, or distressed, as the RBNZ likes to put it, bank can continue to trade while working out just how much or little the bank has in assets. The bank's shareholders would be hit first, but if there were still insufficient funds, then depositors would also potentially take a cut on their deposits, i.e. a haircut. So you could wake up one day and find there's been a bank holiday, and not the kind where you get a day off work and a long weekend. And your savings have been cut by, say, 20%, or maybe, like the really unfortunate Cypriots, 47.5%. But aren't New Zealand bank deposits government guaranteed, you might be thinking? Well, you might be surprised to learn that this was only the case until October 2010. In fact, prior to October 2008, we actually had no bank guarantee scheme in place. But as Australia was about to announce a government guarantee of their banking sector, we were pretty much forced to follow suit. However, the guarantee was only for a set period. Since 12th of October 2010, it has been voluntary, and none of the major New Zealand banks elected to go into the scheme. The scheme was in fact closed on the 31st of December 2011. So, what do we do about the OBR? Well, we wonder if push came to shove, if the government would actually let depositors take the hit, as planned via the OBR scheme. Would they actually let hundreds of thousands of New Zealanders lose a chunk of their bank savings? And if the government did a U-turn and carried out a taxpayer bailout, we would all pay in the end anyway. If a major bank failure occurred, either the depositors lose money up front, or taxpayers lose money via higher taxes, or via the stealth tax that is inflation. Having your own deposit insurance is the way to go, we reckon. Physical gold and silver in your possession is your insurance policy against bank failure, as they will always be worth something. They are the only financial assets that are not at the same time someone else's liability. That is, they have no counterparty risk. Many poor Cypriots learnt the hard way that you can't say the same thing about bank accounts. It's a lot harder to seize physical gold and silver, than it is to pass a law and require banks to hand over a portion of your funds. And in fact, as you've just learnt, in the case of New Zealand, no law would need to be passed, as there is already an RBNZ policy in place. Of course, we do make money from selling gold and silver, so why believe us? It's in our interest to talk up the problems. Better to listen to the politicians and central bankers. They always look out for us, don't they?